All right, if you've been watching the crypto market lately, you've probably heard a million different reasons for the big slide. But what if it wasn't about fundamentals or inflation or any of that usual stuff? What if the whole thing, according to analyst Tom Lee, boils down to a single critical bug, a bug in the code? Yeah, you heard that right. We're going to unpack this because if he's right, this crash wasn't about fear, it was about a fatal flaw in the machine itself. And I mean, this is the bombshell claim right here. Tom Lee is basically saying, hey, this wasn't a failure of crypto. Not at all. It was a flaw in the automated trading systems that are built on top of it. He thinks this one little technical error is what kicked off the weeks and weeks of downward pressure we've all been feeling. Okay, so to really see if this theory holds water, we've got to follow the trail of digital breadcrumbs. Here's how we're going to do it. First, we'll dig into this supposed bug. Then, we'll look at the market makers who got crippled. We'll pinpoint the exact stablecoin flash crash that kicked it all off, uncover the flaw in the automation, and finally, we'll trace that ripple effect that's still hitting the market today. Let's get into it. All right, let's start with part one, the bug in the code. So to set the scene, for weeks now, the market's been, as Tom Lee puts it, just limping along. And this all kicked off after a massive deleveraging event back on October 10th. Now, this wasn't just some small dip, okay? This was the single biggest liquidation event the crypto world has seen in 5 years. So the big question is, why? And this is where Lee's theory really makes a crucial distinction. He's saying this wasn't a crisis of confidence. Nobody lost faith in crypto. No, this was a mechanical breakdown. A negative shock that didn't just scare a few investors, it fundamentally crippled some of the market's most important players. So, who exactly are we talking about? Well, the victims of this big mechanical breakdown? We're talking about the market makers. According to Tom Lee, they're the ones who took the direct hit from this whole thing. And the fact that they got so badly injured is the real reason the market's been just slowly bleeding out ever since. Now, for anyone who isn't deep in all the trading lingo, what a market maker does is actually pretty simple, but it is absolutely vital. Think about it. They're the ones who make sure that when you want to buy, there's always a seller ready. And when you want to sell, there's always a buyer. They're the grease in the wheels. They provide the liquidity that keeps the entire market moving smoothly. In fact, calling them the central bank of crypto might sound like a bit of an exaggeration. But you know what? It actually captures their role perfectly. They stabilize prices, they make sure the system works. So you have to ask yourself, what happens when your central bank suddenly gets a massive hole blown in its balance sheet? Okay, so let's get to the catalyst. Let's pinpoint the exact moment that tipped over that first domino. It all started on October 10th, and it started with a stablecoin. You know, the kind of crypto that's supposed to always be worth $1. They're meant to be the most boring, most stable part of the whole ecosystem. But on this particular day, something went very, very wrong. So just take a look at this timeline. We're just days after Bitcoin hits a new peak, and then bam, Athena's USDE stablecoin, which again is supposed to be pegged 1-to-1 with the dollar, it has this crazy flash crash on Binance. Just for a moment, its value plunged all the way down to 65 cents. Now, it recovered fast, but it didn't matter. The damage was already done because the machines, they were watching. And this right here is where we finally find that bug in the code. See, the problem wasn't really the stablecoin itself. The real problem was the automated systems that are designed to manage risk. And in this case, those systems acted instantly and catastrophically on really bad data. So here's how it all went down. You've got this automated deleveraging system, an ADL, and it sees the price of USDE, which a ton of traders were using as collateral for their loans, suddenly drop by almost 40%. Now here's the bug. The system was only programmed to look at the price on that one exchange. It didn't check anywhere else. So it just instantly triggered margin calls and started liquidating accounts with zero human oversight. It created this massive cascade that just wiped out traders who literally moments before were perfectly in the green. I mean, the scale of this is just staggering. We are talking about nearly 2 million crypto accounts getting completely wiped out, all because of this one little automation flaw. This wasn't some market trend, people. This was a mass execution triggered by a faulty process. And look, this might be the most important takeaway from this whole analysis. The core technology, Bitcoin and Ethereum, they worked perfectly. This was not a failure of the blockchain. It was a failure of the applications that are built on top of it. It's just a huge reminder that the systems we all use to trade this stuff are not nearly as infallible as the assets themselves. Okay, so that brings us to the ripple effect. If the actual crash was just this single super brief event, why has the market been slowly dripping downward for weeks and weeks? Well, that's where we have to look at the aftermath, the long, painful tale of that initial shock. Remember those crippled market makers we talked about? Well, a lot of them got hammered by those automated liquidations. So now they have way less capital. That forces them to reduce their trading activity. And as prices keep falling because there's less liquidity, well, they have to sell even more of their assets just to cover their positions. It's a classic downward spiral, and it all stems from that one initial bug. And just to put all this into perspective, let's look back at a similar event, the Terra/Luna collapse back in 2022. That whole liquidation cascade took about 8 weeks for the market to really flush out. Right now, we're only 6 weeks into the fallout from this October 10th event, so that kind of suggests this whole healing process might not be over just yet. So this all leaves us with one final and, I think, crucial question. Tom Lee says a bug like this is never going to happen again, right? The code will be fixed, the systems will pull price data from multiple exchanges now. So if he's right about that, does this whole event expose a really fundamental weakness in the crypto ecosystem, or was it just a painful temporary glitch that actually created a massive buying opportunity? I think the answer to that question could define the entire next phase of this market.